Agarwal ji gave a very good expert comments on what happened yesterday. It was fantastic.
Okay,
So I think we need to give it a very beautiful international office coverage about the Ashes series between Australia and England.
Okay.
So we start today with a very melodious song which has been sung at the Art of Living Ashram in Bangalore by Vikram Hazra.
Okay.
Ram Narayan Janaki Vallabham Achyutam Keshavam Krishna Damodaram Achyutam Keshavam Krishna Damodaram तुम मीरा के जैसे बुलाते नहीं तुम मीरा के जैसे बुलाते नहीं अच्युतम केशवम कृष्ण दामोदरम अच्युतम केशवम कृष्ण दामोदरम राम नारायणं जानकी वल्लभम राम नारायणं जानकी वल्लभम कौन कहते हैं भगवान खाते नहीं कौन कहते हैं भगवान खाते नहीं फिर शबरी के जैसे खिलाते नहीं फिर शबरी के जैसे खिलाते नहीं अच्युतम केशवम कृष्ण दामोदरम अच्युतम केशवम कृष्ण दामोदरम राम नारायणं जानकी वल्लभम राम नारायणं जानकी वल्लभम कौन कहते हैं भगवान सोते नहीं कौन कहते हैं भगवान सोते नहीं माँ यशोदा के जैसे सुलाते नहीं माँ यशोदा के जैसे सुलाते नहीं अच्युतम केशवम कृष्ण दामोदरम अच्युतम केशवम कृष्ण दामोदरम राम नारायणं जानकी वल्लभम राम नारायणं जानकी वल्लभम कौन कहते हैं भगवान नाचते नहीं कौन कहते हैं भगवान नाचते नहीं गोपियों की तरह तुम नचाते नहीं गोपियों की तरह तुम नचाते नहीं अच्युतम केशवम कृष्ण दामोदरम अच्युतम केशवम कृष्ण दामोदरम राम नारायणं जानकी वल्लभम राम नारायणं जानकी वल्लभम अच्युतम केशवम कृष्ण दामोदरम अच्युतम केशवम कृष्ण दामोदरम राम नारायणं जानकी वल्लभम राम नारायणं जानकी वल्लभम राम नारायणं जानकी वल्लभम राम नारायणं जानकी वल्लभम
Why did we have a vote in the UK to leave the European Union anyway? And now Andrew's looking at me, I'm now concerned. So what we had was a situation where we had a coalition government between the Conservative Party on the right and a centrist party, the Liberal Democrats, and growing support for a party that some of you might have heard of called UKIP, or the UK Independence Party, led by a strong, powerful, charismatic man, sort of in the same mould as Prime Minister Modi, Putin and Trump in terms of charisma and appeal. And our Prime Minister didn't really want to be in a coalition anymore as we were coming up to the end of a fixed-term parliament. And the Conservative Party vote was being split as people wanted to go with UKIP to leave the European Union. So David Cameron, in his wisdom, thought the best thing to do was, in his manifesto, was promise to have an EU referendum on an in-out basis. At the same time, he was negotiating with Europe for some concessions so that our membership wasn't quite so costly, and we had a few liberalisations on what we could do. So we ran into this election with this promise of this EU referendum, and David Cameron got what he wanted. He got a Conservative majority. So after 5 years of coalition, he could now do what he wanted to do as Prime Minister. But the one thing he had to do was to have this referendum, because he'd promised this to the people. And I think he thought it would go that everyone would vote, or the majority would vote to stay in the European Union. But that's not what happened. We voted to leave. We voted to leave by 51.9% majority, so quite tight. And David Cameron, who wanted all this, who created this vote because he didn't want to have a coalition government, then resigned as Prime Minister, quite surprisingly. People thought he'd stay on, but he resigned and left out of the side door. And then we had a new Prime Minister in Theresa May, who I'm sure you all know. Now, she's really only Prime Minister because all the other candidates started fighting with each other, stabbing each other in the back and the front and betraying each other, and she was the only one left standing. And then she's now feeling quite confident. The Labour Party's in a bit of a mess. Their leader's gone. We've got this new leader, somebody called Jeremy Corbyn, who's in his mid-60s. And she thinks she'll call a snap election. Now, we have something called a fixed-term parliament for 5 years, and in order to get a snap election, you need to have 75% of the members of parliament voting in favour, which means the Labour Party, so the Labour MPs had to vote in favour of a snap election. Now, the Labour members of parliament don't like Jeremy Corbyn, but he's very popular with the grassroots. So they saw this as a way of fundamentally Labour losing an election and Jeremy Corbyn being kicked out. And then they'd get back into power who they wanted to lead the Labour Party. But that didn't happen. Jeremy Corbyn did fantastically well, and we ended up with a minority Tory government who have had to go into purposes I think most people could think of as being Christian fundamentalists. So they're not really good for the country. So we're in a bit of a mess politically, and we have a weak government that seems to go from crisis to crisis, and whether they'll last 5 years is debatable. Okay, that didn't work. So I thought it's worth digging into the Brexit vote a bit. So we have a 72.2% turnout, which is quite high for the UK. So 72% of people who are eligible to vote came out and voted. And 51.9% voted leave. But 51.9% of 72.2% is only 37%. Now, that's bad politics to run that argument, but fundamentally only a third of the UK voted to leave the European Union. And the UK is bound by the Act of Union, and there's a number of countries and principalities stuck together. Scotland, as a country, voted to remain in the EU. Northern Ireland, as a sort of country, voted to remain in the EU. So that's two of the states in the Union. England and Wales voted to leave, but London, the engine of economic growth, the powerhouse of the UK, voted to stay. And in terms of age profile, the 18 to 44-year-olds voted to remain. Those above 45 voted to leave. Now that's a bit misleading. The really older generation who'd seen the effects of European wars and the Second World War really voted to stay in because they could see what the peace dividend for Europe had been. The baby boomers, the people who'd benefited from peace and prosperity, they were the ones that voted to leave. The people who benefited most from the Union, the European Union, really ones who said they wanted to go. And we found there was very low turnout in the youth. So the people who were really affected by leaving the Union They were the ones who didn't turn out to vote, and if a few more of them had turned out, we probably would have had a different result. And we found that the areas where there were higher level of graduates, they all voted to stay, and the parts of the UK where we have quite a strong ethnic mix, where we've got a melting pot of different cultures that bring vibrancy to the UK, they also voted to remain. So it's quite a small, hardcore proportion of the lower educated, white, over 45-year-olds who voted to leave. And that's really, sort of in my view, quite sad. Now we're going to... So what's happened to UK gross domestic product? So these are the quarterly growth figures from quarter 1 2016. The vote to leave the European Union was in June 2016. And you can see we've had sort of ups and downs, fairly modest growth. At the time, all the economists were predicting that the UK economy would fall off a cliff edge because of Brexit, and it hasn't. And personally, my view is it hasn't because we haven't actually left the EU yet. That's still got 12 months or so to go. But fundamentally, yeah, the economy's doing okay, but it's a mixed picture. It's very strong in the southeast where Creston Reeves are. The rest of the country's not doing so well. So if you just keep in mind that very modest growth, I think it's then interesting to have a look at what the FTSE all-share index has been doing. So down here, minus 5% post-Brexit almost immediately, and now, today, we've had 30% growth from that period up to 25% growth from the baseline. So that's pretty good, bearing in mind that the UK economy is growing at 0.2 or 0.4% per quarter. So what's going on there? And fundamentally, the FTSE is dominated by a few companies. We're underpinned by US dollar earnings, and sterling's not done so well against the dollar, so all those dollar earnings get converted to sterling, the stock market goes up. And 50% of the dividends in the FTSE 100 come from just 7 companies, which is a staggering concentration. And when you see who those are, Shell, BP, HSBC, GlaxoSmithKline, AstraZeneca, British American Tobacco and Vodafone, all global players. Nothing to do with the UK economy. These seven businesses are driving the stock market growth for their dollar earnings. So the stock market in the UK looks strong, but it's got nothing to do with the UK. And those are just some of the earning figures. So what are the key issues the UK has still got to deal with? Free trade with Europe. We trade freely with Europe. We currently do not have an agreement or a semblance of agreement about what that's going to look like. We've negotiated so far how much money we're going to pay into the EU going forwards once we've left, based on the things that we voted to commit to do in the EU. And that, I think off the top of my head, is like £48 billion. Is that the number? Yeah. Divorce settlement. We're currently not, well, Theresa May says we are going to leave the customs union. This is actually quite an important point, both in terms of trade and accounting. So currently there's freedom of movement of goods across the whole of the EU. What this means is if we're not in the customs union, we have to have inspection of goods, VAT, tariffs, duty at all our borders. And at all our borders means the Irish border. Now, I'm sure most of you know, or certainly those sort of my age know, the UK's history with Northern Ireland. It's a bit like your Kashmiri problems, but fundamentally we have over 100 crossing points between Northern Ireland and Ireland, and we cannot afford to put back in border controls there. That will lead to the sectarian violence and troubles that we managed to get rid of sort of 15, 20 years ago, and could lead to the shattering of peace in Northern Ireland. Financial passporting is a big issue. London is the global economic trading area, stronger than New York, and fundamentally what they won't be able to do unless we can sort this out is clear money from Europe. And currently you'll have seen probably in the press, Frankfurt, Paris, Luxembourg, Brussels are all trying to entice the financial institutions to move their headquarters to those countries, which will be devastating for the southeast of England and the City of London. And currently all trade agreements the UK has are EU trade agreements. They're block trade agreements the EU has with the rest of the world. We have got to renegotiate every single trade agreement with every country we want to trade to, or resort to WTO rules, which no one wants to do. And that's a massive task. And we've got to renegotiate whatever we're going to do with the EU. So the UK needs to start looking outside the EU for its economic future. So that's probably enough about Brexit. And I'll talk about a couple of things that we see in Creston Reeves are affecting our business quite strongly. And I know some of these were touched on yesterday. So AI, or artificial intelligence and machine learning in audit, we see that our existing clients will soon be asking us, what are we doing about AI? How are we going to use technology in our audits? And it will be a prerequisite for any pitch going forwards. So if that's not something that's hitting you guys in India, yet it will do soon. I think those of you who went to the World Congress in Siem Reap will have seen a presentation by a company called Inflow on their product. And I know that Martin and Ian's firm have been looking at it. We're probably not going to go with Inflow. It really doesn't make economic sense due to their pricing structure. And we're now looking at a product called MindBridge, which is produced by a team that left Caseware, which fits in much better with our current audit processes, but still does the AI. And then cloud accounting, again, I don't know how big this is in India, but we had some references to it in the outsourcing presentation yesterday. So we have been working very hard at migrating our clients from desktop to cloud-based software. We've stratified our clients in our business services sector. We know how many clients we think should be moving from desktop to cloud. We've got a timescale over which to do it. It's quite challenging. But we're looking at something up to about 3,000 clients in 2 years we need to migrate on a process. And fundamentally, we're moving those people to Xero, which is an Australian product, but certainly big in the Australian market, or QuickBooks Online. They're definitely the market leaders in the products. The guy who did the outsourcing yesterday referred to a product called Auto Entry, which we're using quite heavily with clients, where fundamentally an electronic version copy of invoice goes into the system and it's posted to the accounting system with all the line item details, all the VAT, all the descriptions, dates, everything all automatically posted with no human intervention. And we've got clients doing 400, 500 purchase invoices a month with no manual input into their systems. And then we're using a product called Futurely, which I'll show you a little bit of in a second, where we're using that to focus on advisory services. So once you've moved your clients to the cloud, you can have things called APIs, application program interfaces, which integrate between your accounting software and other products. So these are some of the stuff we're doing with clients. So these are live linked to their accounting system, showing them graphical presentations. So here we have sales by month compared to last year, sales broken down by category, and then drilling into a different sales area where we can see they've had a particularly bad month and trying to get into the detail of what went on there. And you can compare this data, so last year, forecasts, budgets, do cash flow forecasting, and all live links with the accounting system, and it's brilliant, delivered through a web interface. We share it with the clients, and that gets you into conversations about all sorts of stuff, business planning, strategy, and help grow our advisory services. I don't know if Martin and Ian have seen this product called Futurely. They're coming to... So that's coming, they're pushing quite hard in Australia at the moment. They're based in Brighton in Sussex near our offices. And again, touching on wealth management, we talked about yesterday, we're seeing quite a lot of strong growth in financial services. So we're doing investment management, group pensions, personal pensions, insurance, and so there's life, key man cover, income protection. Lots of tax planning. Rahul educated me yesterday that there's no inheritance tax in India, so we have lots of planning to do around inheritance tax, not something you have to worry about, but maybe that's something that will come. But lots of tax planning around inheritance tax and trusts, and using trusts to pass the wealth down a generation so that the next generation can have the income from the assets, but maybe not control of the asset, so they can have the income and not go and spend the money on buying a new Ferrari. And something we do in Creston Reeves that not many firms do is we have a legal services department, and they do wills, trusts, probate, and administration of estates when people die. And we've then bundled all those up into a core wealth management service where we can look after the assets, we can help write the wills, we can determine with the clients where the assets are going, and actually be right in the middle of that with the tax advice so that the wealth gets passed down, look after the wealth, and make sure the advice that traditionally accountants are given around what you should do with your will, that we tell them to go and see their lawyer, they never go, that never gets turned into a proper plan. We can now do all of that in-house. Again, I think Andrew touched on some Creston values yesterday, and as did Martin on Bentley's. And we've been working very hard on this in Creston Reeves in the last couple of years, and we have 4 key values which are positioned towards both the staff and the clients, and fundamentally they are understand. So we've spent a lot of time to make sure we listen to our staff and listen to our clients, understand what they want, and then use that information to look ahead so we can be more proactive. We then tailor our advice or our career plans with our staff to make it very personal and not generic. And when we deliver that in a way that is crystal clear, whether that's internally or externally, and we deliver it in a way that is human as possible. It's very easy as accountants and tax advisors to talk like accountants and tax advisors, so we try to be human and deliver that in a non-technical way that clients can easily understand. So, Creston Reeves and Creston India, I do have to have a little bit of a talk about this. We find as Creston Reeves that being part of the Creston network is extremely good for us. We are, I think, again, Andrew will tell me if I'm wrong, I think we're the biggest receiver of inbound work from the Creston network and the biggest firm in terms of pushing work out to the network. And we've had some very strong years, particularly with America and Southeast Asia, and like Martin's firm, we have a China desk, which has been great for us. But the reason that I came last year and the reason I've come this year to India is we think that India has fantastic growth opportunities, unlike the West, which is probably economically quite stagnant. And what we want to do is build up those relationships and make sure that we can use the power of the Creston network for Creston Reeves and for you guys, so we can refer as much work between us, do as much work between us, see what other opportunities there are for us to work together, and really build that Creston brand across the firm. And I've given you all a little Creston Reeves handout, so I didn't have to talk to you about Creston Reeves, but I did just want to talk about that briefly. So you will see, and Andrew will be pleased, not only from our slides, but also from our little brochure, how Creston Reeves have really strongly adopted the Creston branding. So we've moved a bit away from Creston Reeves, strongly adopted the Creston branding, gone with the colours, gone with the presentational style. And that's been really well received, and I've been very pleased to see that some of you guys are doing the same. And actually strengthening that brand strengthens our whole client proposition across the world, so that when we do work with another firm, that it looks and feels the same, not just having the same sort of level of service and advice, but there's a same look and feel. And I would encourage you all to carry on. And Andrew Griggs, who's a Creston International board member and our senior partner, is forever telling us all to be more Creston, and I can only encourage you to do the same, because it has paid us dividends. And I'd finally just like to say thank you to everybody once again for letting us come and talk to you today. Thank you.
Mr. Vinod Menon, who is a very senior faculty from the Art of Living Foundation in Bangalore. And as far as the protocol is concerned from the Art of Living Foundation, there should not be any photography or videography of this session. It's a very informal session, so I would just request the videographer and the photographer to down their shutters, please, for the next 1.5 hours.
With intellectuals networked across boundaries, I would say. And thank you, Sunil ji, for giving this wonderful opportunity. My throat is a little bad, but I assure that will not affect my delivery. We are going to discuss on a very, very important, vital subject, which is relevant not only for India, I would say, but for any emerging or fast developing country. And that's the capitalizing opportunity for emerging businesses. I must disclaim that views are personal and not necessarily views of any of the institutions or committees or groups where I represent in various capacities. Well, nowadays particularly we read the opportunities for emerging businesses, emerging markets from investing perspective, because larger economies, larger companies give a range-bound growth, and that's where one of the foremost space being occupied by emerging companies. And we have seen tremendous growth, returns being provided by many of these stocks, many of these companies, which perhaps a larger company like Tata, Birla, Infosys cannot match mathematically. In 2012, a Prime Minister task force was constituted, and the agenda was how India can achieve double-digit growth, how India can take itself to the next level growth. And one of the foremost fundamental recommendation of that task force was that to achieve inclusive growth, a level playing field has to be given to smaller companies to raise growth capital. Typically for a smaller company, not even rather company most of the time, smaller units, be it in the form of proprietorship, be it in the form of partnership. And I think in the context in which we are sitting, it throws a lot of opportunities for all of us, because when any entity gets prepared to raise capital, there are n number of areas where we professionals can directly contribute, whether through group restructuring, whether through IPO restructuring, whether through streamlining of their financials, capital restructuring, and finally, of course, managing IPO. And more importantly, the journey begins with their IPO, because these are very tiny, small micro units, and with their growth aspirations being fueled by this timely capital, we see often that they are doing something or the other, either inorganically or organically. So the point is, this is very, very relevant for all of us, and I am quite pleased that the group has identified this discussion for this 2-day summit over here. So we were talking of little macro perspective and background of this market. The group, the task force recommended that it should be a level playing field, and a global study was carried out, and it was found that whether it is NASDAQ in US or AIM in London or any developed or fast developing economy of even Asia, we find alternate capital market space in almost all economies, by whatever name called. India too had experienced, or experimented rather, some platforms in past, like OTCI, over-the-counter exchange. But because of technology issue, because of competition issues, and perhaps those initiatives were ahead of time from Indian perspective, they could not succeed. Taking cue from those experiences, this time the alternate capital marketplace were founded not as separate exchanges, but they were made part of the century-old system of Bombay Stock Exchange. And of course, National Stock Exchange also followed, and those are the platforms which are now integral part of BSE and NSE. So as we all aware, when we take these companies on a standalone basis, these appear very tiny micro units, at times not very organized. The profitability is driven more of tax incentives, more by tax incentives. Balance sheets are on tax model. And that's how a lot of these financials, a lot of these companies are driven by more bank funding perspective, at how they can procure loans from banks and other sources and grow their businesses. But of course, as we all are aware, this has its own limitations. And we, on a lighter note, we often say that once a company approached bank for taking overdraft facility, and bank demanded that you first do a fixed deposit with us and then we will lend the overdraft facility. Had the company had money for making fixed deposits, it would not have rather required to take overdraft facility. But that's the reality. Indian funding is collateral based, it's not project based largely. And we know how the banking channels are going through in the current phase. So the point is, banking and the traditional sources of funding has their own limitations, and that's where a need was felt that the way larger companies, the growing companies, have the opportunity to tap public markets, similar opportunities should also be given to small and medium enterprises. And there could be umpteen number of definitions, names, and perspectives. So broadly, let's say for our discussion, we call them as emerging companies. Theoretically, they may be called MSMEs or SMEs for various purposes. So India's 60% employment is given by or contributed by these emerging companies, the emerging entities. 40% of exports is contributed by these units. 47% roughly of manufactured output is contributed by this segment. So when we take them as on a standalone basis, they appear quite tiny micro units, but on a consolidated level, at a segment level, they contribute very, very significantly on every macroeconomic parameter. However, challenges are galore, and these units are unable to compete with their peers nationally and internationally because of constraints in terms of funding, constraints in terms of technology, constraints in terms of R&D, marketing, and of course everything boils down to funds. And in that context, based on the recommendation of Prime Minister Task Force of 2010, the government took nearly 2 years to formulate this framework, and in 2012, 13th March 2012 to be precise, Bombay Stock Exchange launched BSE SME platform, where the smaller companies can also raise capital. And there were a lot of questions, and I'm sure all of us will have similar questions, some of them, in terms of how trading will take place in these smaller units, how these smaller units will survive compliance burden, for example. What about governance requirements? Will these units also be required to have independent directors, audit committees, so on and so forth? Will they be required to have, let's say, accounting standards, for example? And there were a lot of debates which took place. And 2012, mostly the time kind of was invested in developmental activities, and we did not see too many listings in that year. There were a lot of questions in terms of this platform is perhaps not very constructive. This is only for tax advantages. This is only to secure capital gains. The platform is too small. A lot of companies felt that this is a junior platform. Why to come and get listed on this platform? Might as well wait for some time and get listed on main board, for example. Today, you will all be happy to note that Indian SME market has become the world's fastest growing market, both in terms of number of companies that have come and got listed, or rather are getting listed every year, and also in terms of returns these companies are providing to the stakeholders. Friends, practically in last 4 years, more than 320 companies have got listed on SME platforms of both Bombay Stock Exchange and National Stock Exchange. And this number has kind of exceeded in a significant way from all the alternate capital markets available or prevalent across. So one of the peculiarity of this market is that there is no dual listing which is happening. A company can get listed either on BSE or on NSE, and unlike in mainframe, companies cannot list on both the exchanges. So we have typically both exchanges running parallelly, and more than 200 companies have got listed on Bombay Stock Exchange, and more than 100 companies have got listed on NSE, taking the total to 320 plus. Cumulatively, they have raised more than $500 million, 3,000 crores in terms of Indian rupees, and the market capitalization is 10 times of fundraise in practically 4 years. There is a provision that these companies can migrate or can opt to migrate onto the mainframe after 2 years of listing. And friends, more than 40 companies out of these 320 companies have already been successfully migrated onto the mainframe. And this incentivizes a lot of constituents of ecosystem that main board listing perhaps calls for a lot of eligibility criteria, a lot of costs, processes. Here is a platform where companies can list in a small way with simpler processes, cheaper cost, and after 2 years, they get adapted to the market, they understand market, and then they get migrated onto the main platform seamlessly. There is a discussion in terms of whether it's a healthy process or practice to allow these companies to migrate onto the mainframe without making them meet the eligibility norms of main board listing, which otherwise for a direct listing on main board they will have to meet. But as of now, any company which has been listed on SME, they can opt for migration onto the mainframe after 2 years of completion of their listing life on SME, and if their paid up capital is more than 10 crores. So friends, these 320 companies, they have cumulatively raised 3,300 crores of rupees. So that brings the average IPO size to close to 10 crores, or little over 10 crores. The biggest IPO on this market we have seen is 58 crores, less than 60, and that's of a pharma company, Zota Healthcare from Gujarat. And there's a huge trend of IPOs getting oversubscribed in recent times, particularly where even some of the smaller companies' subscription levels have kind of outperformed some of the even mainframe subscription levels, in both in terms of number of times, of course, and at times in amounts as well. We closed one IPO of Business Process Management 1.1 Solutions a couple of weeks back. It was a 45 crore IPO. It got oversubscribed by 80 times, and we collected 2,500 crores. And more importantly, we received anchor application from Yes Bank Treasury, from HSBC Mutual Fund, from Edelweiss. So almost every IPO is now getting participation from some of these institutions, some of these large brokerages, and some of the value investors. Whether you call Mr. Damani or Mr. Kedia or Mr. Vijay Mohan or Porinju, or the names which are kind of quite followed by the Indian markets, they have started looking at SME market very closely. And that gives a lot of confidence to investors that here is a market which perhaps is not only growing, but this has to be watched for, as it's giving the highest returns across asset classes. Before we take up some of the more trends and how the market has rewarded the shareholders and some of the case studies, let's quickly have a look at the eligibility norms, the regulatory landscape. Almost every norms, the entire framework of SEBI, which have been very thoughtfully provided, considering the tiny size, the micro size of these units. Foremost, the document observations, I mean the observations on offer document is not at SEBI level. The authority has been delegated to the exchange. And once the merchant banker completes the due diligence and files the offer document with exchanges, it's the exchange which accords in principle approval, and there is no need to go to SEBI for go ahead for IPO. There's only a filing with SEBI, but that's more for information and record purposes. So that's the fundamental difference between main board and SME IPO. There are 2-3 peculiarities which are very important to understand from this market, and couple of them being the shares get traded in a lot size of 1 lakh of rupees. In Indian terms, 100,000 rupees. And a lot of times we often feel that we can take perhaps one share in bigger companies like Reliance Tata Birla, but for a tiny IPO or market capitalized company on SME, we necessarily need to invest minimum 1 lakh of rupees. The philosophy is very simple, that policymakers perhaps thought that these companies are at the initial point of inflection on business life cycle, and hence theoretically they are risky. They do not have the track record of Reliance Tata Birla, for example, and hence man on the street, common investors should be kept away. The investors who have minimum risk tolerance can only or should only be exposed to this market, and that's how both at primary level, at IPO level, as well as for trading in secondary, minimum investment in value terms is not less than 1 lakh of rupees. So that's the fundamental difference between SME and the other prevalent main board. So naturally, in terms of the number of trades are bound to be low on absolute basis. However, to provide liquidity, there's a concept called market making, which has been made mandatory. So if there's only buyer but not seller, or vice versa, market maker has to be present practically all the time on any trading session. In theoretical terms, minimum 75% of the trading session on any given day, market maker has to give two-way quotes, buy and sell quote for any stock, at least for 3 years from listing of any company on SME. If the company opts to migrate onto the main board after 2 years, then of course third year market making doesn't it becomes redundant. It's not applicable because company has gone to the main board. But if company opts to continue even after 2 years, then the third year market making is also compulsory. In terms of minimum dilution, 25% remains constant. So across, whether it's main board or SME, minimum 25% public float, excluding the pre-IPO investors. So even if there's public shareholders sitting out at pre-IPO level, the net offer to the public has to be of minimum 25%. And the minimum investors in number terms has to be 50 as against 1,000 in a main board IPO. So this is by and large the SEBI framework in terms of minimum dilution, in terms of the overall framework. And within this framework, exchanges have their own listing norms, and they have been made quite relaxed and simple so that maximum entities can take the benefit of this platform. It's not very rare to witness even proprietorships and partnerships coming to us and seeking fundraise on this market. And all I can say is that a huge amount of professional advice is required in terms of migrating those companies or transitioning those companies from a non-corporate entity level to corporate level, and where a partnership can be converted into a company format as per the Companies Act. Proprietorship cannot be converted, as we all are aware, and there comes maybe through a slump sale or through business transfer, we need to have a new company formed and the business needs to be shifted from a proprietorship to a company. While of course the tax laws do have provision for tax neutrality and recognizes the conversion from proprietorship to company, But in Companies Act parlance, it's a new company, and there comes the entire regulatory challenges, and we need to see in terms of how the stamp duty aspects will look like, how the business migration will happen, how do we protect the track record, for example, how do we protect brand and goodwill if at all they are sitting at the initial stages of some of these businesses. And after considering those, then we need to check whether these companies fit the eligibility framework for listing. So by and large, 2 to 3 years of existence is desired for a company to get listed. And partnership, they have a pass-through status, their track record is counted. Proprietorship is a challenge, and formally, since it's a new company, in terms of regulatory parlance, the track record of a proprietorship is not counted. So we have alternate minimum net worth criteria that if a company is not in existence for, let's say, minimum 2 to 3 years, then the net worth should be at a higher level. So all those criteria need to be checked before we devise the company for listing purpose. So market making, I think in many economies the concept is prevalent. 5% of the IPO is reserved for market maker, and market maker has to subscribe at least 5% of the IPO, and that constitutes, or that's the sell obligation of market maker. So if after listing there are buyers but no sellers in the market, out of this inventory of shares of 5% of IPO, market maker has to sell the shares to the buyers, and market maker is obligated to buy to the extent of 25% of the IPO. So market maker's obligations ranges from 5% to 25% of the IPO size. So if IPO is of 25%, typically of the total equity, market maker will invest 1.25% of the total equity, 5 or 25, so 1.25 of total equity, and buy obligation is of 6.25%, 25 of 25. So in that range, market maker has to have the monetary obligations. Now in terms of typically or practically how market making operates, it's quite transparent and very well regulated. So I as a market maker, I can't give a quote of, let's say, I'll buy at 100 and sell at 150. So there are spread limits or bands defined under law that I have to have maximum only, let's say, 5% of spread. So if I'm buying at 100, I have to necessarily sell at 105, for example. I have to take the last traded price as benchmark, for example. So in terms of the monitoring on online real-time basis, whether I'm present on any trading session, how much quotes I am giving, if I have exhausted my inventory, I have to intimate to the stock exchange. So everything is fairly regulated on a real-time basis, and I think that gives a lot of confidence to investors at large that even though theoretically or systematically the size could be low or the market capitalization could be small, but there's a market maker who is sitting out there every time to act as counterparty if required. In terms of lot size, that has also been made uniform. So while the one philosophy or theoretical requirement is that it has to have minimum of 1 lakh of rupees, but even within that framework or to achieve that objective, the lot size has been defined for every price band. So for example, if the price is, let's say, 50 to 70 rupees in terms of the initial IPO price, the lot size is fixed 2000 shares. So the shares will be applied in IPO and also will get traded post IPO in the same multiples, 2000, 4000, 6000. So practically the minimum investment becomes somewhere in the range of 100,000 Indian rupees to 150,000, 1 to 1.5 lakh of Indian rupees. Now the question is, what if prices go up and down? And And in SME stocks, it is not very rare to see the prices going, let's say, 2 times, 3 times, 4 times in a gap of 2 to 3 months, because the small size IPO and performance getting multiplied because of the low base. So there's a system that every 6 months exchanges will review, and if prices have gone up or down, by that time the lot size will be revised. So for example, if a 50 rupees priced stock at IPO level goes to, let's say, 500 rupees, the lot size will be reduced to, let's say, 240 shares. So depending on where the price ranges at that time, exchanges will modify the lot size so that the minimum investment again comes down to that level. However, in the intermittent level, at times the investment size go up significantly to 4 times, 5 times. So we are in discussion with the exchanges that it should be perhaps made more seamless and on a real-time basis, and exchanges have appreciated. They will perhaps modify the system of revising the lot size, but as we speak, the periodic review mechanism prevails. So this is typically a listing process which by and large is akin to any mainframe IPO process, and I think at every level all of us sitting out here plays significant role. And look at the numbers. In India we have 48 million, as per the government data, 5 crore units in various forms, and even if 1% of them theoretically or assumably coming to market in not let's say 2 to 3 years, but even 5 years, it's going to be a huge number. And according to us, perhaps this market will far exceed even main board in terms of market capitalization and of course in terms of number of units as we go along. So there's a huge potential, there's a huge opportunity for all of us to add value to this segment at all levels, whether it's restructuring of capital, whether it's helping merchant bankers to carry due diligence, whether carrying out the valuation and assisting in issue pricing, whether it in drafting of a document, so on and so forth. Currently, the entire process we often call that it can be completed practically in 100 days. So that's the kind of simplicity, that's the kind of brevity which has been lent by the system, and at times even we achieve listing in less than 3 months. Some of the companies where the management is proactive, where the teams are supportive, even we have achieved filing of offer document in couple of weeks time. That's the kind of process simplicity which has been attempted, and I think it's giving a lot of comfort to the industries and market at large that here is a system, here is a platform where perhaps capital can be raised on public market faster than perhaps a bank loan will be given to these units in some cases. So that's by and large a brief about how the market has evolved, what's the macro importance, and current market capitalization level, eligibility norms. I just thought I'll kind of quickly wrap it up so that it'll give a complete sense of how the market has evolved. Any questions around that? Yeah, please. Expense, so there are various parts to it, and it will largely depend on the valuation metrics. Fixed expense, of course, roughly it could be, let's say, 50 lakh of rupees in terms of ballpark number, budgetary number. But again, it will depend on how do you see expense. So sometimes these promoters, they will even consider their conversion cost from proprietorship to company, or let's say you need to have authorized capital, for example, So if those costs are loaded, then it will be depend on the level and size of the company. But by and large, if we exclude those, typical IPO process cost in fixed level will be roughly, let's say, 50 lakh of rupees, and then there will be some amount which will be earmarked for fundraising, and that purely depends on how easy or how difficult to raise funds, at what multiple we are bringing those IPO, and what's the growth prospect. So for example, it's a high growth business, e-commerce business, 100% growth, it would be looked at differently. But a traditional, let's say, business which may not be having very growth potential, or industry challenges are there. So we were discussing over coffee with some of the friends that, let's say, it's a steel company or it's a traditional textile company, 1% PAT margin, no growth, then perhaps it will be looked at completely differently. So fixed cost is 50 lakhs, and then fundraising cost will depend on breakup of cost. I do not have, but I can broadly share with you. There'll be the major cost will be the due diligence and offer document filing cost. So out of this 50, let's say 40-50% will be of merchant banking diligence cost, and balance 40-50% will be of advisor to the issue, I mean the legal advisor to the issue, registrar to the issue, dematerialization costs, filing fees. Restatement, typically market fees ranges from 1 lakh of rupees to, let's say, 2 lakh of rupees roughly. Sorry? 5 years restatement as we have for main board, and after listing the auditor has to be necessarily peer reviewed. So only thing is what I experience, and of course I'm sure all of you will agree, that there is a huge volume business. So sometimes we look at them as absolute business opportunity, the fee levels do not match. But if we see it as a business vertical, if we look at this as a business segment over, let's say, 5 to 10 years, I think there's a huge opportunity, and some of the big four or bigger firms have already started working on this segment, carving out a different team, working out different fee levels. I'm sure your network can deliberate as to how you can match cost levels. And so, for example, taking a couple of examples to make it more relevant for this group, we started working on a company called Valentine Group, Ashapura Fashion Intimates. I'm sure you have tracked that. A very small company, started with 80 crores of market capitalization in Indian terms. Today, in 2.5 years or 3 years, the market capitalization of the company has grown beyond 1200 crores. The company has entered into retail, the company has expanded its manufacturing base. DSP BlackRock invested. So every time DSP BlackRock invested, every time, let's say, SIDBI invested, there will be kind of diligence, there are opportunities. We have merged now the subsidiary and holding company. So we listed the holding first, then the subsidiary later on, then we merged. So the point is, when you get associated with these companies, then there are a lot of opportunities to add value as the company is on the growth path. So, but of course, initially the cost levels are under pressure because those companies are not in a position to bear the cost which typically we will consider for, or we will have our standard rates for larger companies.
How's the trading volume of all these companies as compared to the main market?
Yeah, so fairly liquid, I would say, and again, some of the examples, we got one IPO of a very tiny stock, market research company, Majestic Research. It was a 12 rupee stock, 2 crore IPO to begin with. The 12 rupee price is today, I think, more than 700 rupees in less than 2 years. One of the very large institution invested as part of IPO. They exited on screen when the price was 160 rupees. Lot of times I will perhaps add one more question, that what's the sanctity of this price level? How at all the price of 12 rupee can sustain at 700 rupees, for example? And we brought FPO, the follow-on public offer, when the price level was 160 rupees, and that also got oversubscribed. So the point is, when these transactions happen at the current price levels, that give a lot of endorsement that yes, there's a potential and the prices are driven or backed by the business growth. Because the base is very small, we are talking of these companies, and maybe to give more ideas, out of these 320 companies, 50% of companies have turnover of less than 50 crores. 35% of these companies have turnover less than 25 crores. So these are very tiny, small companies, and for a 50 crore unit, it's very easy to multiply 10 times in, let's say, next 3 to 5 years. Second, the valuation is, of course, when we do valuation as merchant bankers and tap public market, the valuation is based on their financials. And there's a lot of streamlining which needs to be done in terms of actually drawing the financials, and that gets streamlined over a period of time. So there again, there's a huge value gap. So both in terms of size, in terms of financials, and their business growth. And when these units get interest-free funds, interest-free funds on time, there again the business multiplies. So for example, the average size is, let's say, 10 to 15 crores. And typically now the IPOs are coming which are of, let's say, 20 to 30 crores. So if a company or a unit of this size gets 20, 25 crores, they get significant boost, and then backed by the visibility and branding, they go beyond their existing territories. They get sensitized about branding, they get sensitized about marketing, investments in their IPRs, and that uplifts their orientation and business significantly. And these are some of the reasons that these companies are actually sustaining the valuation which are perhaps 7-8 times of their IPO level.
That kind of money. So what is next, and how the market making would happen?
Thanks for raising a very good question. So for example, so we'll take both scenario. One is market maker subscribes to 5% of IPO, 1.25% of the total equity. Suppose there is only buy situation, there is no seller, then market maker will have to sell. Market maker will exhaust the inventory, then market maker will be present only as buy, because there is nothing to sell. Now if, let's say, people have started selling, that market maker will keep on buying, and to the extent of 6.25%, market maker will keep on accumulating. Then market maker will stop giving buy, and then market maker will give only sell. So the point is, market making facility will never be kind of dominated. At least on one side, market maker will always have to be present. If it exhausts, it will give only buy. And the moment out of that buy, if market maker acquires, market maker's sell obligation will revive, the sell quote will revive.
3 years. 1 year is the partnership proprietary firm. Second year, you convert that into a partnership firm, a company. So don't you think that all 3 years you can count for the track record?
When we convert to partnership instead of company after 1 year, perhaps the objective in your structure could be that once it's converted to partnership, the period of proprietorship will also get covered.
That is what I'm
Yeah, but they will take partnership deed or partnership date as the basis. So it's kind of written in the SEBI ICDR in terms of track record. So the period of proprietorship, I'm afraid it will not be available. But yes, there are, even
you get that
the network criteria is not very harsh. So if a company has, let's say, 5 crore of net worth, this exists, the track record of survival or existence is exempted. So there are alternate criteria by which company can still be made eligible. Market maker is obligated to buy at the current market price. If prices have gone 5 times up, market maker have exhausted the inventory of shares, market maker will have to give buy quote at the current market price.
So which means for the action, I'm just theoretically
But market
asking.
maker, practically speaking, will give quote for only one lot at a time. 6.25% doesn't mean that market maker has to necessarily buy entire 6.25% at that price. So market maker will give for only one lot, for example. And if it buys at, let's say, 100, the next price will typically be revised to 95. So we do road shows, we call for analyst meet. So it's like a mini main board IPO in practical sense. We have press meets, we have brokers meet, we have one-on-one meetings with institutions, and nowadays, in fact, investors are also quite forthcoming, and rather they are they are like behind us in terms of bringing good opportunities to them.
What are the major benefits which are available to a company which get listed on this portal in terms of regulatory requirements or compliances? So like what you said in your one of the earlier slides, that at the time of IPO, though all the norms are required to be complied with, which are equivalent to the norm for a normal company getting listed on the regular market,
Right.
but the documents will be reviewed by the exchange or someone nominated by them. So post
Yeah.
listing, what are the exemptions or benefits which are available to these kind of companies?
Right. So there are a lot of compliances which directly involve costs and which directly involve too much of administration. For example, preparation of quarterly financial results, limited reviewed quarterly financial results, publication of financial results in newspapers, preparation of physical copies of annual report, e-voting facility. So all those compliances which involve costs and administrations have been relaxed. So instead of quarterly, these companies have to prepare only half-yearly report. And they have to just email to the exchanges and put up on the website. So there is no cost of newspaper advertisements, there is no pressure or cost of quarterly. Annual, in any case, company prepares. So there is only one additional reporting requirement of half-yearly. So to a great extent, the compliance burden has been simplified for these units. But it's not very rare to see some of these units voluntarily communicating quarterly. So, but yes, regulatory provisions are relaxed. Companies can always voluntarily come out with more frequent intervals in terms of their results.
Stated right now, are there any other major differentiating factors which will give any kind of benefit to these kind of companies getting listed on such portal? So this is definitely one of the benefit post listing. Is there anything else in terms of regulatory compliances which gives a lot of benefit to such companies?
No, regulatory compliances meaning the companies, the regulatory framework, the very eligibility norm, the thresholds have been tailor-made for a company of even, let's say, 5 crore or 10 crore turnover to raise public market. So in main board, you need at least 15 crores of operating profit per annum for 3 years. So typically in 3 years, you need 45 crores of operating profit on average on a cumulative basis. So to achieve, let's say, 50 crore of operating profit in 3 years, you have to have a certain size. And before, going to IPO, you have to achieve that size, scale, and of course the corresponding business. So how do these smaller players raise public funds was a question. So the entire framework is devised in such a way that you do not have to wait till you achieve this size. And to further simplify and support, even the post-listing compliances where direct costs are involved that have been relaxed. In addition to that, of course, there are a lot of such examples in terms of getting funds. So credit rating comes to the fore, existing credit rating gets improvised, banking loans become very easy. We have seen companies reducing their interest loan at times by 3%, 4% straight away after listing because of their capital base increases, the liquidity or those ratios improve. So banks lend more against the same collateral. So both in terms of the amount of banking and also in terms of the costs that have come down significantly, drastically. The shares become collateral. So NBFCs and other non-banking, channels finances against even the shares since the shares are listed. And typically, once the companies move on with more history, even banking channels will take these shares, if not as primary collateral, but as secondary collateral to start with. So companies have or promoters have additional collateral in terms of listed shares. You can devise your ESOP plan and you can save on, let's say, direct cash payout to your critical management where instead of or in place of the cash payouts or bonus payout, you can have shares planned as compensation plan. So the question is, or the point is, your shares become substitute of currency. If you want to acquire a new unit, for example, instead of, let's say, taking liquidity out, you can give 5% of shares to the seller. So there are various ways in terms of which these companies can get the same benefit which perhaps they would have thought of or explored, let's say, 20 years hence.
Maheshji, I think his point is from auditor's point of view. Like, what would change for auditor from a compliance and the risk perspective before listing and post listing? I think that is, so to that one point, the SEBI requirements, I think, remains the same, except wherever explicitly it is waived off.
So other than this quarterly thing, everything remains same. As auditors, you need to have peer review. As auditors, you need to have the accounting standards in place. Everything is same, nothing is relaxed. Instead of quarterly, it has to be half yearly. Otherwise, everything remains same.
SEBI guidelines applies to that. Maheshji, one more point. You mentioned that we need to have 50 shareholders at a time of IPO. Consider a scenario post-listing that shareholder numbers shrink to 10. What's the scenario there?
Yeah. So there are 2-3 points to this question, and I must add that all IPOs are underwritten necessarily. So there is no risk of IPOs not having, let's say, 50 investors or amount not getting procured in IPO. Merchant bankers, either through their own book or through, let's say, approved underwriters, they have to necessarily, or we have to necessarily underwrite IPO. So that gives a lot of confidence and comfort that IPOs have to see the success. In terms of shareholders reducing, theoretically, yes, there is no legal requirement to maintain these 50 numbers, but practically speaking, I think the number of IPOs, number of investors are not in hundreds nowadays.
So it could be a tax planning tool also. So if you need to transfer your equity to someone, before unlisted entity, you are exposed to the capital gain of tax, shares. But then if it is listed, and then could be used this platform, in a structure.
But it's an open market. IPOs are getting subscribed 100 times, 50 times, 200 times. All reporting requirements are in place. So, I don't think anything can be planned or devised from that objective. And number of investors are quite many. So regulations are quite, strict. And how do we not market? Because there are statutory advertisements which are appearing. The prospectus or offer documents are available on websites. There are analysts which are or would be covering these IPOs. So we may not have, let's say, that vigorous marketing plan, but it is definitely marketed through those statutory means, and it cannot go unnoticed. And I don't think last, let's say, 50, 100 IPOs would not have got oversubscription to that level. So the question is MSME registration for government benefits and subsidies vis-a-vis listing. So both are completely delinked. The bounties are linked to the MSME limits, which are basically investments in plant and machinery, etc., etc. Those definitions and these definitions are completely delinked. Whether a company is registered or a unit is registered under MSME or not, it really doesn't matter. And their advantages or subsidies or concessions or sanctions will not have any impact whether the company or unit is listed or otherwise. They will prevail, they will continue as it is.
Trading of shares in lots that you have mentioned, that 2000 shares or whatever it may be. So if any person is having odd lot shares, say the trading lot is 2000, one is having shares of 1500 or what?
Right.
So what will be the exit route for that gentleman?
So market maker will have to necessarily buy that. Market maker will accumulate those odd lots, and then market maker can sell out of its sell obligation. As far as investors are concerned, they can transfer the odd lots to market maker. Yeah.
What is the index for these exchanges?
So both exchanges have their own indices. BSE, SME and NSE merge. And those indices are not for trading, but they are reflection of the price movements. There is no FNO or index trading which have started happening in this segment.
Could I just ask, in terms of foreign investors, can they subscribe directly to an IPO here? Can you just explain how that might work?
Yeah, so thanks for this question. In fact, all foreign investors, they can and they do participate in these IPOs either as foreign portfolio investors or as direct investors. But there are certain restrictions in some jurisdictions like United States because of their norms, that if anybody wants to apply or any company outside their jurisdiction wants to offer the participation from those investors, that public offering and the company needs to be registered in United States Securities Exchange Commission, for example. From Indian law perspective, all foreign investors are welcome. There are in fact application forms which are dedicated to foreign investors. Those are available on the internet, on the exchange website, and we do have in fact received foreign participation in quite a number of IPOs through institutions and individuals. So it's quite easy and smooth for individuals and for institutions. Basically, for investors, one of the requirement is that you need to have a demat account in India, and for that you need to have permanent PAN number, account number from tax purposes. If you do not have that, then you have to come through a foreign portfolio investors who is otherwise registered in India. Barring that, it's quite simple and easy, and we do receive practically in quite a number of IPOs.
Thank you.
On exchange, it's like trading, settlement, prices is same as mainframe. Yes. So here are some of the examples to kind of give practical, so there are a lot of institutions which have now started investing in IPOs both from domestic and international levels, including foreign portfolio investors, including mutual funds, international mutual funds, and the participation level both in terms of numbers and value are increasing day by day. So maybe last...
I would like to inform that Mr. Mahavir Ranavat will be with us for the lunch session also. So if there are any further questions, you can always ask.
So maybe we'll quickly wrap up in 2-3 minutes. So more from investment opportunity, these are very high return stocks, and this slightly old slide you were referring to the index. We have our own index, Pantomath SMX 30, and as on date that index has given 70% CAGR over last 4 years. So across asset classes, the returns on Indian SME stocks is highest globally. So that is something, and we can drill down to some of these specific examples. As I referred, Majestic Research, market research company, 12.75 was the IPO price, and highest market price, again it's slightly dated, currently it's 700 rupees. So more importantly, this market has given birth to new generation entrepreneurs, and they are giving birth to industry segments. There is no company listed in Asia from market research segment. So whether we call it market research, we call it electronics, we call hardware designs, hybrid seeds, agro products, some of these industries, loungewear, which perhaps are not there as a structured industry segments, these companies are finding their way out, and they perhaps will form an industry in itself. So that's a huge opportunity for businesses and of course for all of us. So this company, GI Eco Products, is into biofuel. They have pellets manufacturing, and they are replacing the LPG through biogas, which is from wastes and wood which is available through the domestic and forest waste. So those are the kind of concepts are also kind of nurtured through this market. So maybe we'll skip as this is again Kamath restaurants. If you have gone from, let's say, Mumbai to Gujarat, on highways we have these small food outlets. This is offshoot of Vittal Kamath's group. The son and daughter-in-law are in their business. 10 rupee price, IPO price was at par, and it's currently I think at 100 rupees. The highest price was close to 190 rupees. That's the kind of growth in terms of stock prices and the businesses which we have seen. Valentine we discussed, so that's I think about it. We are single largest merchant banker. We have completed 60 IPOs out of these 320, and currently working on more than that. In terms of numbers, the liquidity in our stocks is significantly higher than rest of the market, along with market performance. And we do harp on a lot of behavioral diligence, because financials of these companies may not be the only barometer of diligence. So the social standing, the reputation, the behavior, the satisfaction level of the stakeholders in terms of customer satisfaction, in terms of dealer, vendor payment, banking payments are regular or not, what are the rejection level, whether the top 5 customers of last 5 years are consistent or not. So these are some of the traditional ways of behavioral indicators, which gives a lot of ideas to us when we do due diligence, and we would like to carry our diligence model. And perhaps because of this stringent diligence, which is much more encompassing, much more pervasive and broad-based, not limiting only to statutory diligence, perhaps we have been able to consistently perform despite of having the largest base. And I'm sure your network can directly complement. Maybe we'll sit with Sunilji and some of you separately in terms of how do we work together in terms of formulating a complete ecosystem where from end to end, and even post listing, perhaps if some complementarity exists, we'll be very happy to kind of discuss that. We have tied up with Yes Bank recently for developing a MSME ecosystem in Maharashtra. We have got tied up with Government of Maharashtra for creating thought leadership initiatives across the state. So we are identifying those players, whether government or private, who are interested in terms of developing this market, and we are very serious player in this market. And I'm sure the fact that this discussion has been scheduled or slated for today, I'm sure you will have a lot of ideas around that. So happy to discuss further, whether at specific individual query level over lunch or as a strategy. So thank you very much for making it quite interactive, and I hope it was useful to all of you. Thank you very much.
Thank you very much, Mr. Mahavir Lunawat. May I request our member from Raipur, Mr. Ramesh Kumar Singhania, to hand over a memento.
Empty as of now, so we just wait for a few minutes for the others to join in.
I basically have about, I qualified as a cost accountant in June 1982, long time ago. So I'm now 60. My friends tell me you are not an old foggy mind, which I agree. So before I actually started Value QB Consulting, which is a firm of my own, I used to be finance director for a Swedish company for about 12 years. And then I thought I had enough of corporate life, and then let me do something different. So I started to practice. The presentation is, I think, all of about 15 minutes or so, because there's nothing much to, it's more regulatory in nature. But then after that, I'm looking forward to as many questions as you have. Sunil just told me I've got 45 minutes. So you have to drive the time up to which how long you can keep on going. I can, of course, continue indefinitely as long as you want. The law basically is the Insolvency and Bankruptcy Code 2016. That was enacted in December 2016. The actual movement came when RBI became very active in trying to kickstart a resolution process. The reason for RBI actually kicking off the process was because banks were taking an eternity in trying to find a solution to the stressed loans. So, for example, in the case of Alok Industries Limited, the strategy, the SDR was called the strategic debt restructuring, as you know, actually started sometime in December 2015, and they still couldn't find any solution for more than 1.5 years. That is because there were 53 banks, and it was practically becoming impossible for 53 banks to say yes to everything and then the SDR to kick off, which I think is the primary, motive behind enactment of IBC itself, is that it basically forces the creditors to take a call yes or no, because they know that if you don't do it, then the company basically goes into liquidation. So, the applicable law is the insolvency code for corporate persons. Today, the code actually covers corporate persons, which is LLPs and companies, individuals, partnerships as well. But individuals and partnerships have still not been notified. So, currently what is going on is only LLPs, which are very few really, and companies, which are corporate persons. So, the applicable regulation for that to be read in conjunction with the with the code is the IBBI Corporate Insolvency Process Resolution for Corporate Persons Regulations 2016. These two basically have to be read together to understand the entire impact of how does it actually happen, how does the process work. The National Company Law Tribunal, NCLT, is called adjudicating authority under the code, and that is the one which actually drives it. But what they have done basically is that they have kept the role of the adjudicating authority, or AA as it called, only to the extent that it decides on whether a case has to be admitted under the code, and then it only steps in unless there is a complaint against the corporate debtor or somebody files a case under something called section 60 of the code. Otherwise, it just steps in only at the end of 180 days or at the end of 270 days. So, they kept the courts substantially away from day-to-day management of the insolvency resolution process. They only decide whether we are admitting, and admitting, then is basically up to the resolution professional to do it along with the committee of creditors. I will explain what that is. There is the intent basically of the code is not like a pre-pack that you can see in advance, like in UK you need this pre-pack and you ultimately sell off the company. Here the whole idea is essentially possibly because there is a lot of social cost or social dimension associated with India being a different economy altogether. Shutting down or liquidation is the ultimate, if nothing else at all is possible. Otherwise, the effort is, can this company or can this corporate person be revived and keep on going as a going concern. So, basically under the code, there are three types of creditors who can actually invoke the provisions of the code. One is the financial creditors themselves, and financial creditors basically mean all the people who have given money against time value of money. Strictly speaking, therefore, if somebody has given a loan without any interest cost, actually he is not charging a time value of money, he is just giving it, more like a gift. There is a question that he may not be able to invoke the insolvency proceeding, but then all other people who have given loan fund to the company, in case there is a default, they become financial creditors, and therefore, they can move an application with the NCLT under what is called section 7 of the code. The other category is the operational creditors. Now, operational creditors basically is a huge definition. The number of players which are covered under operational creditors, which also includes government debt, is dues are more than rupees 1 lakh, can actually move NCLT for taking the company into insolvency resolution. And third is that the corporate person itself can also apply. So, for example, if there is a company which is stressed, it knows that it will not be able to service its debt obligations. Under section 10 of the code, it actually can move the IBC and say that, look, we want ourselves to take the company into insolvency resolution process. The threshold is 1 lakh. So, debt has to be minimum 1 lakh rupees of unserviced or default amount, as they call it, before you can invoke the IBC. There are a number of cases, basically insofar as the financial creditors, and very famous is the SR case of those who actually have gone through when SR actually questioned. For example, they said that, look, our SDR is already on, we are about to have a solution, this debt is, we don't agree to the amount of the debt, nothing works. So long as it's clearly established that a debt was due and the corporate person has defaulted, the NCLT will admit the case. In the case of operational creditors, they have provided a mechanism by which saying that if the operational creditor gives a notice that before I am asking you to pay, there is a statutory form under which if I pay notice, if I give a notice to the creditor, and if after 10 days he does not get any response, then he can move. But if it is settled, then of course, chapter is over. The interesting part is that the corporate debtor against whom a notice has been served cannot raise a dispute after receipt of the notice. So, a dispute cannot be raised against the operational creditor after the receipt of the notice by the operational creditor. So that is basically to protect smaller creditors, because otherwise any large corporate debtor will say that I have this dispute, that dispute, and the smaller party will actually go down the tube just fighting a case, which is not possible. So, that is one of the important conditions. Insofar as corporate debtor itself is concerned, there is no specific provision except certain clauses like it should not have already gone through insolvency resolution process or should not be a part. Those are general definitions. But what the courts are generally doing is that they are trying to ensure that there is no fraudulent intention behind applying. For example, in earlier cases when we just started, some smart people thought that because they were personal guarantors also. So, they said let us move NCLT, and after that my obligation as a personal guarantor will go away, because the case will come under insolvency resolution. That the courts have later on become smarter, so they are not actually admitting cases where they see that the intent is sort of more motivated application rather than there is a genuine case. In the case of the companies themselves, yes. Yeah, there has to be evidence that there was a dispute in existence prior to receipt of the notice. But in that case, the corporate person does no escape. The NCLT will admit it. Yeah, that's why I tell, in my consulting capacity, I tell people that if you have a dispute with anyone, please keep it on record. Because if he moves against NCLT even for 1.5 lakh rupees, exactly. So, but that's how the law is prevailing. You cannot raise a dispute after receipt of the statutory notice for payment. That's how the law stands. Okay, now the intent of the court, as I said, always is resolution, but a resolution within a given timeline. So, there is a primary period of 180 days from the date the application is admitted by NCLT, and which means that ideally the solution to the problem should be found within the first 180 days. If you cannot find, if there is no solution, then there is only one time extension permitted by another 90 days. The court does not have any mandate to allow any more extension for any more period after one time extension of 90 days. If there is no solution within the next 90 days also, then there is mandatory liquidation. And I think, that is where the merit of the code, some people call it demerit, particularly in the context of large cases like the one that I am currently handling. But otherwise, the merit of the thing is that you cannot continue indefinitely in pushing the problem under a carpet. You have to take a decision one way or the other, find a solution, or simply allow the company to liquidate and then realize value whatever you can. For example, one of the first cases was a company called Innoventive Limited in Pune, which ultimately is now under liquidation, because they simply could not find a solution. There is something called a fast track resolution process, which is basically for very smaller companies comparatively, where the time instead of 180 days and 90 days extension is 90 days and 45 days. But that is more academic, because there is hardly any fast track resolution, fast track application currently under play, at least those which are the known ones. There should be presence of a default. Yeah.
That is a continuing default, or suppose if the company make a payment to the creditor in a year, and next year they again make the payment. So it should be continuing default or not?
No, there is no definition of continuing default there. At the point when you are applying or when you are making application to NCLT, does the default exist?
That is fine. But suppose if the default came into the existence once a month back, so that NCLT can accept the application of the financial 1 month pending.
Of course, yes.
But
it can be 1 day.
It can be 1 day.
Of course. There is no provision, there is no minimum that the debt must be outstanding and not paid for 10 days or 1 month or 1 year. No. Differentiation between secured and unsecured creditor.
Okay, so it means you mean to say that any FI or bank from which we have taken the loan, they also make the application.
But they are the financial creditors.
No, they are the financial creditors, but debts are secured.
That doesn't make a difference. Security has got nothing to do with my right to recover. I can enforce the security to get my money back if I want.
Right.
But that doesn't mean that only because I am secured that there is no obligation on you to pay me my money.
And in your second point, in the case of suppose there are 100 suppliers, and one supplier made an application to the court, the other suppliers can object or not?
No, they may want to, they can also tag along. But as far as NCLT is concerned, if the debt is there,
Right.
that's why it's providing a 10-day mechanism. So a company says, if I give you a notice and within 10 days if you pay me, I am done.
Even you mean to say that,
Yeah.
that there is no requirement to take the permission of the other suppliers?
No,
No.
no. Now, there is something called the IRP and the RP, very quickly. And IRP is basically is called interim resolution professional. When the process kick starts, because an IRP has to be appointed by the court. So IRP and RP by definition in officers of the court. Like today, my appointment, though recommended by a financial creditor, is actually appointed by the court. So, which also means that even if I want to not to do the assignment, if I get tired or if I can't do, I need to satisfy the court as to why I can't act. I have no choice to say, guys, I am gone. Here's my resignation. I have no choice. I need to go and satisfy the court as to why I have to withdraw. But then the process is like this, that if you are a financial creditor or if you are a corporate person applying under section 10 for insolvency, you need to say, we recommend him to be the IRP. In the case of an operational creditor, there is no such requirement. They can if they want, but if they don't want to, then they can go to NCLT. NCLT will refer the case to is a board. The regulator under the code is Insolvency and Bankruptcy Board of India, IBBI. And you can go to netncibbi.gov.in is the website, but they are the regulator. So, all insolvency professionals like me first need to get our accreditation registration done with IBBI, then only we can be appointed. For that you need to pass examination. So NCLT would then make a reference to the board and the board will then say, we recommend that you can use this particular person as an IRP. Now, the IRP's term is 30 days, because that's why it's called interim. So, within 30 days, the IRP constitutes something called a committee of creditors. The committee of creditors basically is a committee of financial creditors, if there are financial creditors. If there are no financial creditors, then the top 18 or the largest 18 operational creditors would form the committee of creditors. Note that if there are financial creditors and operational creditors, then the committee of creditors is only of financial creditors. Operational creditors have no place, unless one or group of them represent more than 10% of the total outstanding debt. So, for example, let us say in the case of Alok, the numbers are quite staggering, but then let us say that like in the case of Alok, the financial debt admitted is close to 29,500 crores as of now, the stressed loans. 29,500 crores. But then if the total operational creditors combined together were more than 2,950 crores, then there was a case of a representative could come onto COC. But that's not the case. 10% is a very large amount as far as large companies are concerned. So the IRP also has to constitute a committee of creditors. All decisions must be taken with 75% voting rights saying yes. So it is not like a special resolution in the case of companies that 75% of people voting, attending and voting. each one gets a voting right creditor in ratio of his debt to the total outstanding debt of the company. That becomes the voting right. So, all decisions have to be taken by the committee of creditors with a 75% voting right saying yes. And normally the way it is actually happening in real time is real practice is that it actually is done always electronically. It's very, very difficult for all the, because you can actually take a physical vote as well, but then everybody has to be present in the meeting, either through audio visual or through physical presence. But since that doesn't happen in real life, it is done electronically through CDSL is the only entity currently which manages this process. So, 75% have to say yes. So, the IRP has to constitute this committee of creditors, and after it constitutes the committee of creditors, then the COC within 30 days has to meet and decide whether they want to continue with the IRP as the RP. The difference is interim resolution professional and resolution professional. Essentially, the resolution process is carried out by the resolution professional. IRP's job is to just take control, make sure that assets are not getting stripped away, claims verification. There are a number of things which I will just explain how tough can be life of an IRP. I have gone through the process. So, like I was first appointed IRP, and then the COC said, or the committee of creditors called COC said, okay, let's continue with Ajay Joshi as an RP as well. And then I became the resolution process. That happened on 16th of August 2017. So, the toughest job of an IRP as a process, I mean, if any one of you decides to become an IP and then take registration, the first 30 days you have a lot more to do. I mean, I can share you privately, I lost about 2.5 kg of weight, because many times I was ending up having dinner or soup at 4 o'clock in the morning in the hotel coffee shop. That is because you have to make a public announcement within 3 days, you have to apply, you have to ask people to send your claims. Financials are very important, financial creditors. Like in the case of Alok, there are more than 56 financial creditors. It's a huge consortium. So, they have to say, you have to verify the claims, verify the entire calculations. In case operational creditors are coming, verify their claims. You have to appoint registered valuers too within 7 days of your appointment. And then if you are looking at, for example, Alok Industries, where the unrevalued balance sheet was more than 12,000 crores of assets, and with multiple step down subsidiaries which also have to be valued aggregated, even to just run a due process to appoint 2 registered valuers can be quite nerve wracking, because the time is only 7 days here to do. And then you also have to then, so there's this claim verification going on, and particularly because these are the first 12 cases which actually went, everybody was struggling with the new animal. So, you had really no clue. You have to learn, you have to know about the company, you have to know about what it does, how you're going to take control, how you're going to manage cash, because cash is a major thing. There are a number of things you have to do. For 30 days are very, very stressful for an IRP. After that, the life tends to come to a little bit more even keel. Of course, issues start, there are a number of issues that you even don't get to know in the first 30 days, but those are not killing the process. Those can always be handled after the first 30 days. So, first 30 days are very, very tight for an IRP. He also has to prepare, for example, let's say if it's a say in the case of Alok, it was 18th of July. So, you have to make sure that provisional accounts and balance sheet as of 18th of July is available. It had till 30th June, but then you have to also quickly do within 30 days for the 18 days. There is something called an information memorandum which has to be prepared, which are a number of things, including details of material litigations, etc. All that has to be done and presented to the COC before his first meeting. The COC's first meeting has to happen within 30 days, because otherwise the term of the IRP expires. And IRP is the only person later on RP actually who runs the meeting, who is the chairman of the COC's meeting. So there are a number of things that you have to do in the first 30 days. That's why I say it's actually IRP's nightmare. I have actually learned how tough it can be for, particularly in larger cases. Like Alok and other 11 account for nearly 25% of the total NPAs of the banking system. So, very, very large accounts, very complex accounts, multiple plant locations, etc. Number of things that you have to deal with, try to understand what you are dealing with the company and things like that. After the IRP thing is through, then as a process flow, there are a number of things that are required to be done on a continuing basis. For example, there is a mandatory requirement to send out an invitation for getting bids for the company. When we say getting bids, it's not in the pre-pack sense, but getting resolution plans. So you have to decide what is going to be the eligibility criteria for what is called resolution applicants. The term is resolution applicants, which means companies who want to take over this company with the purpose of resolution of the debt and keep the company on a going concern. A fundamental requirement on the part of IRP/RP is that he has to do all what he can to keep the company as a going concern. That is very critical, because I said the idea of the code is not to liquidate the company. The idea of the code is that it must ultimately turn around, and I think primarily in my mind driven because of the social impact. For example, in my assessment, in case Alok was to go down the tube, you are looking at about 1.25 to 1.5 lakhs lives getting affected, because you are close to 19,000 employees. Average family size of 4 is 76,000. There are more than 2,200 operational creditors. They are family members, they are sub-suppliers. It's a large, very large ecosystem that a large company like Alok actually supports. All of them would suffer significantly in case it was to go down, it was to be liquidated. So there are two parts. One part is just to make sure that the company runs one way or the other, continues to operate, employees keep on getting salary. For example, I did the first interim finance transaction in the country when I raised 150 crores from a finance company. Costly, but it was new animal. So I raised at a pretty high cost, but there was no option. But the 150 crores that I raised has allowed the company to operate, and people keep on getting their salaries. It still does 300 crore rupees of manufacturing turnover, is still EBITDA accretive. So primary purpose of my being an IRP/RP not served, because I know that the company is working. That is my very important primary responsibility as an IRP/RP. But otherwise, then I have to run a process where I invite expression of interest for bids, for resolution plans, define bid documents, or what we call process memorandum, shortlist candidates, prepare a data room, a virtual data room has to be populated, because people need to get time for doing due diligence. You have to run multiple number of COC meetings. I have done already 6 so far. I might end up doing 5 more in the next 2 months as the process moves. Alok, for example, is already under extension period, because we didn't have anyone putting in a bid for the first 180 days. So now the last date for Alok Industries is 14th of April, by which I am really hoping that there will be 1 or 2 applicants who can be then discussed, and they can maybe take over the company and keep on running it. So, so all of this. So basically, there is a due process. Of course, now I am much more wiser in hindsight, as all of us are. We all become wiser in hindsight, but initially it was very tough, even trying to figure out what you want to do. Today, if I do a second case, I already know what I have to do to work like a clockwork. I know parallelly what I can do. That time it was very, very, very unknown what we are required to do or not. But basically, due process has to be run. The company has to operate. The code is ambiguous about it, because it says it shall continue to run the company on a going concern basis, RP. But for example, technically, if tomorrow nobody is people to give me 1 rupee extra, then how do I actually run the company? I can't run the company technically, because there's no money. But then given that, basically do all what you can to keep the company running is one of the primary objectives of this. Then, now this is a part. There are a number of things which are challenges / unknown. What happens? Now, for example, one of the biggest concern in the process is what happens if the promoters of the company are hostile. They are the one who actually have created the company. They know the ins and outs. The customers know them. The customers don't know the IRP or the RP. The customers know them. Under this latest, which has now got, yesterday it has got assent to the President, under the amendment to the Insolvency and Bankruptcy Code, if there is an NPA or non-performing asset which is outstanding for more than 1 year, or if a promoter has given a personal guarantee for the loan which has not turned an NPA, the promoters are disqualified to bid. So, a lot of promoters will now find it practically impossible to bid for their own companies. They only have one option by which, if all the overdues, principal plus interest plus charges, if they can clear, then they can participate in the process. But if they have so much of money, where was the question of the account getting NPA? I mean, just think, if a promoter had the money to bring in 10,000, or I think in the case of Alok, for example, the amount worked to more than 20,000 crores of due. If he had that kind of money, where the question, the company would have never become NPA in the first place. And they are saying then, and the connected person are saying their family cannot become, there are number of restrictions have been placed on the promoters to become a potential resolution applicant for their own company, which was not the case before this ordinance. If a lot of the people agreed and not vigorously challenged the application by financial creditors, because all of them thought in good faith that they would be allowed to bid for their company. This amendment that came through the ordinance and now has become a law, totally changed the game midway. And therefore, your biggest challenge, in the case of Alok, of course, not there, but let's say theoretically, if a promoter is hostile, or employees turn hostile because they owe their, they are completely devoted to their past owners, it can become extremely difficult for, because there is no escape for RPO. Under law, he can go to NCLT, he can say, I want your directions, that you tell them to cooperate with me. But then you can take a horse to the water, you can't make him drink it. He says, I am very ready to cooperate, but how do you can't keep on going back to the court, okay, look, he is not giving me this. They will admit your application after 15 days, by that time the company will be close to liquidation. So, how do you actually manage the process? In the event you have a hostile promoter or the employees are hostile, is going to be a very, very significant challenge in this particular process, what actually is going to happen. Then this issue also is between the COC and the promoters. You see, you can have two scenarios in real life. In one scenario, the bankers and the earlier promoters had a smooth relationship. They understood that the promoter is not siphoning away the money, that there are genuine cases by which he simply cannot pay. Intent is not wrong, in which case COC can support some way. Either he can support that was actually, this COC was actually, this equation was much more valid pre-ordinance or the pre-bill days, where they could support and allow the promoter to come. It is now not so much relevant because the promoters can't bid now. But even otherwise, so if, for example, if COC and the promoters had a good relationship, the RP and the COC develop a good rapport, then life is much easier. Because, for example, I raised 150 crores, I got an immediate sanction. Somehow, I don't know, possibly they like my face, they say, okay, we will give you, in the first meeting itself, I got a sanction for 150 crores, when they never even knew me who I am. But let's say now I want to go for 30 crores more. If the relationship is, my relationship with the COC is even, is balanced, I have a high hope that I can get 30 crore rupees more sanction, because I can't raise unless they say yes. But if because some reason, if my relationship is not very good with them, and then they say, sorry, we are not going to allow you 30 crore rupees, you still have to run the plant, you have no escape. Those are the kind of things which are going to come about in this process as this process unfolds, as more and more companies. But these are the challenges that you will keep on getting if you decide as an RP. How do you manage all these contradictions and make sure still that you don't lose the sight that you ultimately are still focused on getting a resolution plan for this company duly approved. So this, then there's very issue of how do you strictly read the code. For example, let me give an example off the record. You have 4 promoters who have got 4 Mercedes Benz which were taken by which were taken on lease. Technically, a lessor is a financial creditor, and under the code, section 14 of the code, there is a moratorium, which means that the lessor cannot take possession of the property during the first 6 months. That is how the code operates. Now, if I read very strictly, I have to give them a notice. You say, your cars are under my possession. Please file something called a form file C. I am not going to pay. I am not going to pay you. The promoter oblique his sons or senior executives come running and say, boss, if you do this, this man is going to send bouncers and take my car away. How will I go? Now, let's say the amount is only 10, 15 lakh rupees a month of lease rent. No, I have 2 options. I can make the life very difficult for them by saying, no, I will not pay anything, they cannot take the cars away because it is under there. I don't care about the bouncers. If I take that particular approach, what I ultimately maybe end up doing is souring my relationship to an extent where I may. So, it is a balance between what is my larger concern. My larger concern is going concern. I need the employee support. I also need the promoter support. Legally, I may have all the recourse, but in real life, it is not going to happen. So, I need the promoter support so that the company can run. Because in 6 months, in a multi-plant locations, what is that I can learn or do, or even force people me to do, because they may not do. But my obligations are still there to make sure that the company is going concern status is maintained. So, therefore, there are certain tricky situations where you may have to make some compromise with without getting into too strict reading of a law, just to make sure that your larger purpose, the larger good is employees keep on getting salary, company continues to operate, and ultimately you have a resolution plan. So, you have to be, you will keep getting these challenges as you go along as to where do you drive, how do you drive a balance between a legal provision and what is the reality of life as you are trying to run a company or trying to find a solution for the company. The final slide is basically that basically I think interests you more of that would be interest to all of you here is how do you actually participate in the process. Number of things. For example, I have Grant Thornton working with me. Under the code, I have to basically make sure that you will ultimately require a team. In a large case, you alone cannot do anything, because a critical part is the code says taking control of the assets. Now, physically, of course, you can't say, okay, this asset now I am putting security of my own in the plant, because plant is functioning. But what you actually take control of is cash. What comes in, you know, but what goes out has to be very strictly controlled. You must always know that there is no siphoning that is actually going for a specific purpose. You have a process by which each and every rupee that goes out is accounted for through all the banks and things like this. So, you require teams. You require teams to vet the MIS. There are a number of things. So, as a practice, CA firms can actually either, of course, they can decide to act as an RP, one of their promoters, because RP cannot be a firm as of the law today. It only has to be individual. But technically, a partner can qualify as an IP and decide to act as an RP. There is, of course, now a new question which has recently come up is that if he is an RP as such, can he even go back to his own firm and award him a contract for servicing without running a due process as to whether it will be arm's length or not. A new arm's length principle has come between RP and his advisors. But technically, you have a huge opportunity of tying up with RPs to provide them insolvency resolution process support services. Which can, I mean, for example, at one time I was using 22 people from Grant Thornton. I still use about 10, 12 all the time. So that's and you know, fee are not bad. I can't tell you the fee, but the fee are not bad. I mean, some of them, of course, are public processes, but they have been fee where for larger thing, some of the people have quoted 2 crores a month only for providing that kind of service, which is not a small fee. A fair amount of work, but that's a very good opportunity available. If you don't want to do that, then of course, you can work with RPs to what is called carry out the claim verification process as a standalone service. Lawyers do it all the time, but lawyers are doing it more from verifying the security or the charges. But you could say we can help you in getting the claims, verifying the claims, checking the calculations and things like that. That's one service can be done. The other service is that you can help them in raising interim finance if you are in the funds raising game as a practice. Because nobody ultimately would be able to run these larger cases, even mid-sized cases, without raising additional money. That's a given. Money for getting working capital is going to be a challenge all the time. And most of the time, banks are not prepared to, obviously. Banks don't give additional lending because the moment they give additional lending, they will have to make a provision for that in their books, because it's already an NPA account. So, raising money through the RP for the firms would be a good practice area. Another practice area is to actually work as a registered valuer for doing the assets of the financial assets. Because what's happening is, and that's what exactly happening. For example, if you go to Duff and Phelps, if you go to RBSA, who are the larger registered valuers who are very well known, who are doing into this practice, they actually go to their networked or their known chartered accountant firms who know how to do valuation, and are then using them to do financial asset valuation. There are two parts. One, of course, is whether you are getting into derivative valuation or intangible valuation. That is one particular part. But the other part is, if you have one subsidiary or two subsidiaries, and then you have 10 more step down subsidiaries, all of them you have to value, consolidate, and then work out the value of the investment of the parent company into the subsidiary company. Because under law, the parent company is independent of a subsidiary company. So, while we consolidate under our reporting requirements and things like this, the fact is, as an RP, I don't have a right over the assets of the subsidiaries. So, therefore, the value of investment of the parent into the subsidiary itself is a financial asset, but you ultimately have to value that. So, for example, in the case of Alok, there were more than 11 step down subsidiaries, or they had SPVs created to take money outside in Singapore and Middle East. All of those had to be valued and then consolidated to say whether this company, the parent, does he have an investment or a loan value, because that's a part of his. That's a part of value of the company. The reason being that under the code, which I have not mentioned here, you have to appoint two registered valuers to work out what is called liquidation value of the company. The liquidation value of the company basically is the minimum, is what is going to happen if the company was to be sold out. The whole idea being that if you are a dissenting financial creditor, then you have a right over your portion of the liquidation value. That is the principle. That's right. So, that is one area you can do. The other one, of course, I already told you. Then there is something which is coming up now and is going to go very much up is forensics, or something called a certification under section 43, 45, 50 and 66 of the code. Forensic, of course, you all know, because forensics are being ordered by COC itself. Even the RPs are now ordering forensics if they think that there is a major problem somewhere. The reason for that forensic is section 43 is talking about identification or determination of preferential transactions. Section 45 says whether those preferential transactions were actually undervalued. Third, section 50 says if there are extortionate transactions that have been entered into. For example, if for a related party, the terms of the trade or terms of a loan given are such that they would normally not be done in an arm's length relationship. They are called extortionate transactions, something which the conscience will never accept. And 66, which is a very big, is fraudulent transactions. Whether fraudulent transactions have been undertaken by the corporate debtor in the. So, these are the 4 sections in which, for example, I am currently using a CA firm for giving me an independent certification on 43, 45, 50 and 66. This is a very big opportunity for chartered accountant firms, because they know how to delve into that, they will be able to work it out. The important thing is to establish connections with the bigger RPs. Of course, E&Y has an RP, Deloitte has an RP of their own, PwC has, Grant Thornton has. I am not talking about the big 5 or 6, but there are a number of cases which are going to come, where big 5 will not be there because fee level is just not, will compensate them. But working with those RP or IPs is a practice area for chartered accountant firms to work in this particular area. All right, with that I'll shut up. I have spoken enough. Now, if you have any questions, you can ask me. Yes.
Resolution not done through restructuring of the debt?
No, the resolution itself is restructuring of the debt. The idea of resolution is the restructuring. For example, if you are a bidder, you will say, okay, forget 29,500, that's not possible. If I think that my sustainable, what I'll do, I am going to say, what is the sustainable level of debt? So I will take an assessment of the operating performance of the company 5 years down the line, do an NPV and say, this is the amount of debt that I think I can sustain. So I'll go to the banks and say, look guys, 29,500 crore doesn't matter. The sustainable debt of this is 6,000 crores. You have to take a haircut of 23,500 crores. 6,000 crore is only what I'm prepared to service. That's all about structuring. The resolution plan itself is a restructuring of the debt.
No, but the point is whether there has to be a bidder for the.
There has to be a bidder.
Oh.
That's what I said. I have to invite, I have to issue an expression of interest advertisement, which I did in Economic Times 2 times, asking people to put a resolution plan. So they will come out. So if somebody has a strategic interest, for example, there's someone in Indonesia who just spoke to me today morning. He says, can I go and see the plant? Because I have a strategic interest in acquiring this company, for example. So he will come back and say, okay, our machines are like this, so many people are there, this kind of facilities. I think we can get X much amount of volume out of this particular company. Operating profit percentage is this is the sustainable level of debt. The bank, they tell banks, this is what you ultimately are going to take a haircut. But out of the sustainable level of debt, or I may say, okay, take haircut, but I'm also giving you equity, for example. Or I can also say, I'm giving you some upfront cash to make you happy, but remaining sustainable debt ultimately, I'll service over the next 10 years. That is all the resolution plan is all about. It's like this. There are two views in this particular part. The question is that technically, while you are paying, while you it's like this. If you are issuing debentures, you are meeting the test of whether you are giving funds for whether you are giving funds for time value of money. Yeah, that is true because you are earning interest. Correct. The issue there is basically a quantification. So some people's view is that since you are a guaranteed shareholder, you are not a creditor in that particular sense, but resolution plan needs to take care of your interest.
See, ideally, CCD is the amount which is never meant to be returned as debt return.
Exactly, that's what I'm saying.
And therefore, in my view, it cannot be the debt.
Yeah, so therefore they say that they will not admit, but they will say that you may have to provide for how you are going to address their interest part, which is supposed to be given to them.
One more thing, post resolution, the personal guarantee of the promoters gets absolved from that? Or
that is not yet clear, because what has happened is currently the part 2 of the code, the personal guarantors are not covered currently. So there is a view, but the current legal view is that the order does not absolve them because that was issued in their personal capacity. So therefore, the right of the banks, unless they specifically approve that we are saying in the resolution plan that we will, for example, not just personal guarantee, for example, pledge shares or pledge houses of the promoters, personal assets of the promoters.
That anyway you can take possession, but then just I'm saying that like how the company need to be.
No, I cannot take possession today.
No, I'm saying my point is that like the company need to be insolvency. So if nothing works out, then you have to sell assets and get resolved. Right? Similarly, when the promoters are personally guaranteed, in that scenario, whether the promoters are also required to be declared insolvent.
Yeah, now I'm coming to that. You see, the promoters as an individual are covered under that part of the code which is yet not notified. What's called the part 3. So since they are not notified, their regulations have not come. The act is in place, but regulations have not come. So therefore, that section has not been notified. So very technically, banks still have a right to move against the promoters to enforce their security. But at the same time, if regulations come, then the individual capacity, they can be declared insolvent.
Okay. Can I go ahead? Yeah. So you mentioned that when committee of creditors is appointed, there are committee of financial creditors plus if there is one single largest creditor, say more than 10%.
No, if your operational debt is more than 10%, then the representative can come.
And if that more than 10% is one of the sister concerns.
Oh, no, a related party cannot be a member.
Related party cannot. Okay, that is one. IRPs, as you rightly mentioned, IRPs and RPs are individual.
Yes.
What we generally see, and I've been doing a lot of valuation assignments for a lot of RPs, that they are Grant Thorntons and PwCs of the world, and that is how they represent their practices.
Yeah.
So how is it legally being taken? Because most of the time I'm meeting, so this assignment has gone to PwC or Grant Thornton.
Yeah. I mean, for example, how did I come into the picture? Only because was somebody known to me in Grant Thornton and said, boss, will you please become my IP? But of course, I'm completely independent of Grant Thornton. But it's like this. You see, what happened was, the history is like this. When the first 12, which account for nearly 186,000 crores of the total debt, or 25% of that, when the first 12 got referred by the banks, before they got referred by the banks to NCLT, the larger question facing the banks was, is one thing to apply, but how are you going to manage the process? Because nobody had clarity. As I said, it is not just you as an individual. You also require a lot of support, sometimes multidisciplinary, to be able to run an insolvency process. So, for example, somebody like me, for example, who has, let's say, spent 25 years as a corporate manager, and then otherwise is qualified and has acquired experience. Possibly, not everybody would have that kind of experience, but otherwise, if one IP, let's say, for example, a learned company secretary, for example. Now, let's say, now he's an IP. I'm not saying this, but let's say he never worked in corporate, or you have only very limited consulting experience. There are hundreds of things which are otherwise, or financing things like this, which you don't have knowledge, so you require a lot of support. So, the question in the mind of the banks was, at that time was, how do you ultimately handle this process? And therefore, they ultimately worked out that, okay, let us first look at the big 5 or big 6, because they have multidisciplinary teams. For example, E&Y at one time still is one of the largest corporate finance practice that they used to have. And then the evaluation of the practice, and then the merger of the practice, and everybody. So, they said, let's look at 5 and 6. There was a big legal question as to, so what they did was, even the big 5, what they did was, for example, Dinal Shah, who is a partner in E&Y, is an IP also in his private. So, he is also IP in his personal capacity, though he is also a partner in E&Y. But since he is not an employee, he was entitled to become an IP. Recently, only now these guys have turned around the board and saying that now you prove to me how when you gave the work of support to your firm, how are you going to prove me that it was on an arm's length basis? Which was not the case earlier. Now they are bringing that particular regulation.
In dispute resolutions, I am interested in one particular asset. The company is having multiple assets.
Yes.
So, in that situations, how that things take place?
You see, the regulations per se allow an asset or a group of assets or a group of facilities to be also considered transfer of those or dispose of those as a potential part of the resolution process. But the larger context there are 2 overriding themes. One is, does the resolution plan, how does the resolution plan address the concern of all stakeholders? That is number 1. And number 2, it's a resolution, it is not asset stripping. So, therefore, as a going concern, as an entity, how it will continue to operate. Now, for example, put it like, now let us say that suppose I am a multi-business enterprise, with one of 2 are not core to my business. For example, in the case of Alok, if you see a balance sheet, they are huge, they suddenly decided we are very good, let us go and get into real estate, and then lost a lot of money. because everybody at that time, every promoter thought at that time that we are the best. If we can manage textiles, we can also manage buying and selling buildings or creating buildings, correct? So, in those cases, a resolution applicant may say that, look, the core business of the company is this. These are the ones which, as a part of my plan, I will dispose of, sell it to somebody who has a strategic interest in that. But the idea that I will only take this, which is one of the core, and others let they decide what, that I think the COC will never approve.
Multiple core business then?
Well, if there are multiple, then you see as each other revenue stream, and then you can have a plan that, okay, I am taking two. But the question again is that if you are one entity, for example, if you are one entity. Now, if he says, for example, look, you are today in one entity, I want to create 3 legal entities and run them as individual processes, but I am taking care of them. And later on, I may decide to sell off one particular line of business to somebody else. That still means, as an employee, everything, you are still maintaining the estimate, because his liability is to estimate what he will admit as a claim. So, therefore, if you, when I presume the slides will be shared with you, one of the group I have said of services where CAs can be helpful is taxation advisory. So, if I have X amount of claims which have been filed as Form B by tax authority and everything in dispute, how do I take a view? What is the amount? Am I going to admit 0? Am I going to admit full, or I am going to admit part? I have to do something. I don't have an escape saying that because there is an appeal, I will not take a view as to what I am going to admit as a claim. That is one part. Now, let us say that one part happens. When the plan comes, plan will say, okay, for all the operational creditors, let us say I am going to give 20 cents to a dollar. So, everybody who is operational creditor may get 20 cents to a dollar. In the case of statutory liabilities, there is a big question here, whether the government still has a right to go into appeal against, not appeal, no, but whether it has a right to appeal for the balance 80 cents to a dollar. The current legal opinion is their right to continue litigation against the company for the balance 80, which is not provided for in the plan, continues unabated. They can still keep on fighting the litigation for the balance 80, but 20 they will get.
Priority over the recovery?
This is only for the government dues.
No, I am saying technically anybody can continue with the claim, but as far as government, yeah. There is no priority. In fact, under section 53 of the code, the government dues, I think, come step 4 or step 5 of the waterfall. Sorry? Okay. In terms of waterfall, the first priority is something called corporate insolvency resolution process cost, or CIP cost, which is my fee of my advisors, to the extent cash flows are not covering that. So, that is the first priority. After that, it is all the workmen up to 24 months of wages, plus secured creditors in the same proportion. After that, it is employees up to 1 year. Then there is another category, and after that there is I don't remember now, but after one more step after that government comes in. So, it's pretty low on the waterfall.
No, the secured creditors are secured only to the extent of the security value. So, balance comes into a lower category.
No, that is under, that provision is 52. What it says is that if I actually, 53 is basically a liquidation scenario provision. But what it says is that as a secured creditor, I have a right not to transfer my security to the RP or to the liquidator. So, if I think that I am able to get a better value, but this is actually going to work if I have an exclusive charge. If I have an equitable mortgage, it is simply not possible because you can't enforce the security, because all the 53 have to say yes. But let us say I have got 2 machines, specifically English mortgage in my favor, where I have an exclusive charge. I have a right to say that I am not going to transfer that charge and the property to the liquidator, but I will take it out and I will sell it myself. If he chooses to do that, then he gets out of the step 2 of the waterfall. Whatever balance of his due is not recoverable out of the, after he disposed, he then comes 9th on the waterfall, but it comes much lower. But he is still one priority, step 2, one priority over the unsecured creditors for recovery of dues. Yes, please, sir.
2 or 3 questions. Can a foreign supplier can file the application?
Of course, yes.
Of course, sir. And the appropriate authority is the NCLT.
NCLT is the adjudicating authority, yes, yes.
Fine. Suppose if one supplier filed the application, so because as you said that on a single day default, he can file the application, and the amount should be more than 1 lakh rupees in such a case. So if the company, if the company is financially sound, and suppose company is not giving the money to the suppliers due to so many reasons, maybe dispute or not dispute. So what is the auditor's responsibility in such a scenario while issuing the auditor's report? Because the suppliers has filed the application at NCLT. Now the going concern question arises in such a scenario.
Only if you think that the company is going to shut down because somebody wants 1,50,000 rupees.
No, that is fine. But
admission in NCLT, that is also NCLT will presume that the company is not going concern, as they also mentioned.
Yeah, the only if it is proven that the company cannot continue to operate. I mean, COC may still say, okay, fine, the resolution plan is there, but then, for example, it's not linked really to auditor. I mean, only if there is a risk. Yeah.
One is referred to the tribunal. So there they have the option to prove that it is a dispute. Okay. Operational creditor, suppose I got the receipt, the company got the receipt, the letter, whatever.
So you'll approach the tribunal and say, I'm withdrawing my application.
He cannot dispute, but he can go for the dispute at the tribunal itself.
It can go to tribunal and say that we are settled, please, like happened in the case of Arcom. In the case of Arcom, a Chinese bank had moved application. Then later on they made a settlement.
One last question.
Last question.
Just wanted to know.
You people are driving the time. I'm not driving. My job is to answer your question.
Last question from my side. Employees will be covered under the definition of operational credit.
Yeah, that's right.
Right. So like we had seen case like Kingfisher and all in that era. So if something happens, then even employees can invoke this particular.
Absolutely.
I have
Two questions.
Yes. So one is if the terms of
yeah.
Okay.
He's the big boss. Yeah. So he decides. Okay.
If the terms of credit period are not in writing, so the operational creditors have no recourse. Is it that there is no default is proved?
Well, very technically that would be the case.
Okay. And what are the?
I mean, if you are saying that I supplied a service or a good on payable when able basis, then obviously you cannot say it is a dispute.
Okay. And what are the risks?
If at all, that's a possibility. Yeah. Yeah.
And what the risk the RP runs? Risk of any charges against him, failing in his duty.
As far as RP is concerned, I have told my wife I could end in Sabarmati jail, which is the NCLT bench. The biggest problem as an RP is, I don't know whether somebody will file a claim that RP either has misused his powers, or has been unfair to me, or has been rampantly corrupt, took money from the promoter. There can be a number of things can be proven. My worry is not so much that I am an RP, because that time I can use company's money to defend. My problem is not that I will lose, because I know that I am completely honest. My bigger problem is after it is all done, and if 1.5 years somebody raised a claim, then how do I defend myself? Today in India, you don't have even a professional indemnity insurance available. There was one case, somebody from foreign came, he said, I will give you a indemnity solution for against cost. The premium was more than my entire fee that I would have learned. So I told my wife, either I could be in Sabarmati jail, or you will have to stand outside of a Gurdwara and ask for roti as a part of the langar, because we had nothing left. That's the risk I have.
And you have all the signing power, check signing powers now transferred to you?
Yeah, what happens is that under the resolution process, the power of the board is suspended. So the entire power of management vests into the RP. I may decide to delegate power subject to COC's approval. For example, I have done so that 4 people of Grant Thornton can countersign a request, and bank will not pay till the time it is countersigned by 4 people of our partners of Grant Thornton. But otherwise, all asset disposal, everything. What I have not gone through detail is every order will be accepted by me, because then you can't run a company. Plain and simple. You can't run a company. I know. That is how the promoters got decided. No, that is what is given sanctity. The promoters, if the NP is more than 1 year old and they cannot clear their dues, cannot bid. That is where the game has changed. That's the biggest amendment is that. Of course.
Thank you very
I'm
much,
saying-
Mr. Achay
You
Joshi,
have
for
to tell
this.
me when to shut up. I'm fine. Yeah.
Thank you. Thank you very much.
Thank you.
I would request our senior member, Mr. Krishna Rao, to hand over a small memento to the speaker.
I will preserve my comments in detail, maybe for the next occasion, but I just wanted that the objective of these kind of conferences is to understand as to how we can be part of the 1% of the firms. As you all know, under the ICAI, we have about 70,000 firms. And not more than 1% firms are having 3 partners or above. Most firms are 1 or 2 partner firms, 99% firms. And therefore, can we work out some methodology, something, including our thought process, so that allows us to develop and create a robust organization. And therefore, I had put together some thoughts, and I'll just quickly run through a few minutes, and I will not dwell in detail, but then just a few points. So this is what the conventional approach used to be. One single person or 2 partners, they would have understanding of each and everything. Whether it's audit, tax, accounting, payrolls, business advisory, restructuring, capital market, whatnot. And we all know whether we can do justice with that or not. It's a time of specialization. This has been the conventional approach of the small and mid-sized CA firms. Most of we belong to that fraternity. And I have given certain points. This presentation would be mailed to all of you. But I think this is very self-explanatory presentation. And once you go through, many of the things you would be able to relate to yourself. And, we can find as to how we should be moving forward. So these are the points which I had mentioned. I said that it is not that the world is only changing. Our world is also changing, From Raipur, I am connected to the entire world. The world is moving. We have the firms within the Crestor network, which is 2 partner firms to 20 partner firms, from a revenue of $100,000 to 30 million, 40 million, $50 million revenue. So this kind of the variance is available within even one network. So things are changing across globe. Are we changing? That is what we need to understand. This is what I mentioned, that there are points which would clarify you. Can we continue with the conventional approach under the current scenario? The point is no, you can't. We have to change. These are I'll just take 2 minutes on this slide. I think, this is a great alignment of our thoughts. Everything begins with a thought. And if we are able to, understand these points and form up our strategy and thoughts, I think we would be doing great work, and that can help us transform our firm, our organization from where we are today and what we intend to be. So the first thing is the vision. You have to have a vision. Many of the practicing units, especially in India, they don't have the vision as to where they want to be. And everything starts with your thoughts. If you have the right thoughts, right vision, what you intend to do next year, 2 years, 5 years, 10 years, unless we do that, it's difficult to achieve what we intend to have. The team alignment, you have to have a right team. You have to have infrastructure, technology, and support. You have to have the client-centric approach. This is a very dear subject to me. And I think unless we think that the client-first approach, and unless we think, because we are in the service industry, the client trusts us because he thinks that he is a guy who is my consultant, my advisor, and he would always think of my interest first. The moment we break that trust, I think we would no longer to have, that kind of relationship which we ought to have. And therefore, it is important that we have the client-first approach. Regulations, regulators, and risk management. Lots of regulatory changes happening. I have these slides on all these points. I can run through that, but then there's no time much. But then you can get through all the points in my presentation. We have branding, communication, business development, very, very essential part of today's practice. If you don't address to this aspect of our practice, believe me, we would be lagging behind. Peers, the competitors, we also need to understand who our peer is, what he is doing, what is strategy, what are the new areas of practice other guys are looking at, and we'll have to be somewhere, understand from them, somewhere we have to team up with them, and somewhere we have to, work together with them. Markets and overcoming the disruptions. The markets are changing. Sometimes we focus on certain markets, certain service lines, and sometimes those markets, those service lines may become irrelevant for us, and therefore we have to quickly change our gear and ensure that we get into the market which is more rewarding nowadays. So I have given on all these, pointers which are very self-explanatory, though bullet points, but I think to this audience, I don't think I need to elaborate, especially when we don't have time, but otherwise I would have loved to do that. The last point which I had mentioned, that overcoming the disruptions. Friends, when we think of growing, when we expand, the challenges would come, growth hazards would be there, the disruptions would be there. But once we have decided that we have to move forward, I think these are the part of your game. You have to accept it. You will be cheated, you will have some breakdowns, but then you'll have to keep moving and don't be afraid of those breakdowns. So this was my presentation. It will be mailed to you, all of you. And one point which I just wanted to mention that, and that's very dear to my heart. We all have to have some differentiating factor, and we need to see as to what market expect you to deliver. When we started our practice back in '91, and I was very watchful of the scenario as to what is happening in the market. And the one point which I observed very clearly, that most of the professionals of those days, they would be busy selling their knowledge to the client. Whereas the client is never interested in buying the knowledge. See the dichotomy, the disconnect. The professionals say that, under section this and this is the interpretation. Client says that I don't need any interpretation. You tell me what I need to do. But then the professionals would seldom provide the right solution. They would rather confuse him more. And that was the time I thought that, can we have a differentiating approach whereby we can differentiate? And we thought that let's not engage ourselves in selling the knowledge, but providing the solution. And I think that made us, reasonably, successful in our area. But then I think that is what can help all of us. This could be one differentiating factor, but for many of us, there could be some different, aspects of our practice or our DNA which we think this is more appropriate. We can imbibe those thoughts and create that as a differentiating factor. With this, friends, I close this presentation, but then it's indeed pleasure that we had 2 days fantastic, this get-together, this deliberations and whatnot we had. We played cricket, we had... Ganesh, can you come to my side, please? And Murli, may I request you to be here this side. So we had a fantastic, time. People not only from India, Richard, Martin, Ian, they came from the very far geographies, and that speaks about the, how the Cresta network is intimately, we are connected with each other. And from India also, many partners are here. And this amalgam of the people, especially on this kind of occasion, gives us this understanding that we are one family, and we can always trust each other. We can expand our business by having a reliance on each other and also leveraging the capabilities of the different partners in different locations. And that made us create the Creston India entity. We resolved that day before yesterday I mentioned, and I think that would be a huge, a big step in our moving forward, and that would really help us grow faster. Yeah. As you all know, as I mentioned that the country-specific conference is normally hosted by the member firm, and here we had Murli's hospitality. He was the host for everything. Whatever we asked, even some member in the bus yesterday night mentioned that Murli, we want to have pan. For my other colleagues, it's a mouth, freshener. So, and you have to go to the market, buy those, stuff, and two of your choice, because there are hundreds of varieties. So you have to choose what you want. Somebody has to go there, bring it, tailor-made. And so Murli said, yeah, don't worry. By the time you reach hotel, it would be ready. And somebody, he ordered somewhere, 10:30 in the night. And somebody brought those pans. It was when we entered the hotel gate, the pans were available to us. That's Murli. Thank you very much. May I request you to kindly have rounds of applause for Murli and his entire team. And the team, I must make a mention, right from day one when we arrived here, and whether it's a night, day, 11 o'clock, 12 o'clock, early morning, 5 o'clock, they are here. I don't know what Murli magic is that the people are so sticking, and Murli, we have touched, we are touched with your humility and your hospitality. Thank you very much.
I'm really thankful for Mr. Sunil and Mr. Ganesh, who has fully supported me. And I'm very thankful to all the people who are all together with me for the purpose which I started. I'm very happy. And I'm giving small memento to Mr. Sunil. Mr. Krishna Rao. Because you came all the way and then...
It's actually our duty to do this.
No.
Thank you very much.
Joshi.
This is all on behalf of all the parties.
All the parties. Mr. Joshi is my other partner. It is Mr. Ganesh.
Thank you so much, Mr. Joshi.
One more time again conference with the permission of the Sunil.
Thank you so much, Murli. And indeed, we are falling short of the words, but then you are great, Murli. Thank you very much. Any of the audience you want to say about this conference? Yeah, and Andrew, please come this side. You are also part of the organizing team in being the Creston representative. So some comments or something.
Okay, thank you very much, Sunil, and again, thank you to Murli and his team for organising a fantastic conference with a great variety of speakers. And I think my observations, actually brought together by Vinod this morning in his session, the 4 I's that he emphasised. My memory wasn't clear enough to remember all of them. I only got 3 down, which was innovation, imagination, and intelligence in the way that we're leading and developing our practices to cope with the changes that are going around at this time, and making sure that we don't live in the past. I've been an accountant now for 30 plus years and think I know a lot, but actually talking to our people in our firms, seeing what's happening in the world around us, not being slaves to our own egos about knowing the answers to everything. And you've got a great collaboration platform here in Creston, India. There are skills and abilities and knowledge within the firms around areas such as wealth management, outsourcing, insolvency, capital markets. Make sure you're collaborating together to really push forward on your practices, and it's a great launching pad, I think, you have here for a great future for Creston India as part of Creston International as a whole. And remember, there are lots of people out there in the wider Creston family that have great knowledge around things like wealth management as well, or cloud accounting, outsourcing. So reach out as well into the international network, use conferences and things to develop your knowledge of what's happening in the accounting world. So I say thank you very much again for the invitation and the opportunity to come to Hyderabad. Great night last night, and all the best in your travels home and for 2018.
Thank you, Andrew. And especially for Andrew, let me make a mention that within, I think, 50 days or 40 days, he's twice in India.
Yes.
He was there in the 9th or 10th of December for the Forum of Firms program. And again, he chose to be here at our request. Thank you so much, Andrew. We know that how committed you are for the question and especially for the Indian members. Thank you so much for your. Thank you. Anyone like to say something, good or bad? All good goes to the Murli and team. All bad goes to me and first to me and then to Ganesh. We would share and ensure that next time it is improved. Thank you.
Well, I was extremely excited at we coming to end with announcing Crest in India. I believe it's only the start, and any partnership requires a lot of commitment, compromise on the way, and I believe at Crest in India we'll have that. And it's probably we are in for an exciting time. Well, for the conference, it was absolutely well organized. And the sessions that we had, not only yesterday, but also today, they were very nice and very well organized. And we were extremely excited with the Faluknama yesterday. Thank you.
Thank you, Vinit. Any more things? Any comments? Anything?
Just I would like to that I've joined very Christian 15 days back only, and this is my first conference which I joined. And I must say I'm very happy to associate with Christian India. And that I was a part of the Big Four, and I worked with Pricewaterhouse and St. Young. But I never type of such conferences I joined. This conference is full of entertainment, full of knowledge, full of fun. I really happy to associate with Christian India.
We were in Mumbai, before that we were in Goa, and we now need to decide as to where we would be next year and when. We had member firms approaching us, me and Ganesh, that they want to have this conference in their particular city, and but then finally it was unanimously closed, decided that next year we would be in Raipur. And so Rameshji, can you come this side? So see the host of the next year so that you can relate to. And the dates would be 10th, 11th and 12th of January. So this is a time which I don't think from a professional deadlines point of view also it is reasonably okay. From the season point of view, it is not the wedding season. So availability of the hotels as well as we the individuals would be reasonably assured. And therefore I think, and weather-wise Raipur would be, January 2nd week would be fantastic. And I think Raipur is a very happening place. Raipur for my colleagues from out of India, it's a central India location and very well, yeah. So Raipur in this map, it is there, yes. So it is a good, very industrious city. Singhania was in the same hostel where I was. Many of my other partners were also there in the same hostel. He was senior to us, and I think he chose to be in Raipur for the last about 30 years as a. Yes. So Ramesh, I'm sure that.
I request all of you, so please be part of this next seminar conference, and I request all to be in large numbers, especially from the outside India also, and we will try with help of your presence and all, we try to be the best. I request all members to give suggestions also, what we can add into the conference, what we did in Goa and in Hyderabad. Whatever suggestion comes, we will try to implement that. Thank you. I again request all of you to be associate and to be present in the conference. Thank you.
Ramesh is making one more request that not only the business partners, but the partner in life should also be there, in Raipur. We missed this point here in this conference for certain reasons. So that next time, and he would make sure that they also get the, adequate attention and the, diverse activities for them to be, occupied. So thank you very much, Rameshji. We have a small, I tell you, Ganesh is a very, a guy full of ideas. Yesterday evening we decided that it should be Raipur. And he has a video on Raipur right now in his inbox. And that is what, it was a pleasant surprise to me. And let's see what Raipur is all about. Flights and you can approach wherever you want to go now. Lunch is on the, okay, where we had a breakfast. Yeah, lower. So the lunch is there, and we would have the national anthem now.